Hi, Mick McLaughlin, the head of ETF distribution for Deutsche Asset Wealth Management. Have the great pleasure today to have Abby Woodham, an ETF strategist, join us to talk about first the case for emerging markets, second how currency has an impact in those markets, and then three, offer a solution on how you might play those markets and reduce the overall volatility. Abby, thanks for joining me today.
Thanks for having me.
No problem. Want to talk a little bit today about emerging markets. Obviously, the U.S. valuations are extremely high right now. You talk a little bit about the opportunities that Deutsche Bank sees in the emerging markets area?
Sure. So it's been a tough asset class over the past months and couple of years. Emerging market economies have had to go through a tough adjustment period. They've had to find new growth models after years of expansion, and for some countries, a commodity boom that has led to overheating current account deficits. This has been particularly the case for Latin American countries. The collapse in commodity prices has been a material headwind for them. Most of them are commodity exporters. The picture is a little better in emerging markets, countries in Asia. They are typically commodity importers, so the headwind is not felt as much there. What is great about emerging markets right now is the valuation picture. Valuations in developed markets are looking relatively pricey, but emerging market equities are looking rather cheap relative to developed markets.
So let's talk a little bit. It seems, obviously, when you start looking at international markets, we've heard a lot about developed, but anytime that topic comes up now, there's obviously an impact as it pertains to currency. And the dollar index just continues to rise higher and higher. What kind of impact is currency having in the emerging market space as it pertains to both risk and return?
Sure. So the dollar strength has been felt in emerging market currencies to a similar extent as it's been felt in developed market currencies. Many investors have a core allocation to emerging market equities. They're interested in the higher expected risk of the risk and return of the asset class. They're interested in the diversification benefits that it might offer. But what many investors might not be aware of is the impact that currency can have on that investment. When an investor takes a position in international equities, and of course that includes emerging market equities as well, they're really taking a position in two sources of risk and return. The first is, of course, the risk and return of the local equities, but they're also taking a position in the risk and return of the local currencies. What that's meant is over the past months and years, past 3 years or so, as the dollar has strengthened significantly against most world currencies, both developed and emerging, investors will have found currency exposure in an emerging market equity allocation to be a significant headwind to return. It's also been materially increased risk for an emerging markets equity allocation. We think that many of the fundamental drivers behind dollar strength will continue in the coming months and years. And so we often talk to clients about hedging the currency exposure of their emerging market equity allocation.
So you know me, academics is great, but let's talk solution, right? So when you look at these currency hedge products out there, how do they help make the case for either staying invested in emerging markets right now or actually adding to that position?
So like I said, many investors have a core allocation to emerging markets, but they might be feeling a little skittish about the asset class. They might be worried about further downside risks. They might be worried about volatility. And this is where we think that currency hedging can be a really great solution, especially for risk management. When an investor has an unhedged position in emerging market equities, the volatility of their investment is being impacted by the currencies. So emerging market currencies on their own can be extremely volatile, which contributes to the overall volatility of the investment. But also, perhaps more importantly, emerging market currencies and emerging market equities have been highly correlated over the past decade. So what that means is that when emerging market equities are doing very well, currency returns tend to be positive. But when emerging market equities are doing very poorly, emerging market currency return has tended to be negative. So the highs are higher, but the lows are also lower. And this can be particularly the case during a market crash. That's what we saw in 2008. An unhedged investment in emerging market equities declined significantly more than a hedged investment in emerging market equities. And that higher high and lower low can also contribute to meaningfully higher volatility of an unhedged investment compared to a hedged investment. So we think that hedging currency exposure can be particularly interesting for an investor who is risk budgeting. They can spend that volatility elsewhere. They can spend that risk elsewhere. It's also compelling for investors who would like to maintain exposure to the region. They're interested in the diversification benefits. They're interested in the higher expected return. But they'd like to perhaps protect against downside risk, protect against drawdown and manage their risk. We have a solution for that. We have a currency hedged emerging market equity ETF.
So let's talk a little bit about that. DeAWM Trackers has, as you mentioned, a solution. Talk a little bit about that solution, how someone could go and express the views that you've talked about here today.
Sure. So our ETF, the ticker is DBEM, and what it does is it tracks the MSCI Emerging Markets Index on a currency hedge basis. So that's an index that many investors are already familiar with. It's a very widely followed emerging market equity index. So it tracks those same underlying equities, but hedges out the currency exposure. So what's done on a monthly basis is the currency weight within that index is determined. And then we use currency forward contracts to hedge out that exposure. So over the course of the month, gains or losses in the currencies should be offset by losses or gains in the forward contracts, leaving investors with purer exposure to the equity return of those underlying holdings.
So simply, same index, 30-day forward on top of it to hedge out the currency, eliminate some of the currency risk in the portfolio.
Exactly.
Perfect. Abby, thanks for spending some time talking about the investment case for emerging markets, certainly the impact that currency has in those markets, and offering a little bit of a solution for those that are looking to possibly reduce the volatility in their portfolios.
Thanks for having me.
You got it.
Carefully consider the fund's investment objectives, risk factors, and charges and expenses before investing. This and other important information can be found in the fund's prospectus, which may be obtained by calling 1-855-329-3837 or by viewing or downloading a prospectus. Read the prospectus carefully before investing.